I'm going to start with Florian, but I'd like to ask him how has relative value of covered bonds versus other asset classes held up?
Well, I mean, you've mentioned it earlier. Right? I mean, at the end of last year, moving into this year, there was a lot of nervousness on the side of the issue community. It was the 3-4 months of the balance of power actually having shifted back to the investor side, and it was all about how are the first few deals in 2019 going to go, and they did go all right. And from that moment on, as you said it earlier, we retightened. I mean, German fund brief for 5 years at +5. That was nice and easy to remember at the time. Now we're good 7-8 basis points inside that level. It was all driven, or to a large extent driven, by bank treasuries. Absolute yields have proven to not be a factor, or at least not a decisive factor, because those guys obviously look at relative value relative to other benchmarks, to govies, to 3 months Euribor, EONIA, to the deposit rate. And as far as those benchmarks and approaches and targets are concerned, we're still in an equilibrium. We're still in an okay-ish place.
I think a lot of investors were caught on the wrong foot at the beginning of the year, because when the end of the QE and then entering the reinvestment phase, everybody expected more or less a widening of spreads and increase of new issuance premia, etc. And that didn't really materialize that much. At the beginning, first couple of weeks, yes, modestly. But then it was realized that actually there is more demand than supply, and then everybody tried to jump on the train and say, okay, as long as there's still some yield on there, I'll gonna buy it, and that led to a massive tightening pace. And the more, of course, we got throughout the year, and the more additional measures of the ECB materialized, the more the investors actually said, okay, let's take whatever we can get so far. And I think, of course, we are now in extremely, the yield level we have now is crazy, no doubt about it. But does it harm the covered bond? Not that much yet.
Bank investors have helped at the beginning of the year, and also have helped during the negative yielding new issues. But we also saw that the investor base has somehow narrowed down to these bank investors left there, and also some official institutions, some of them now, which is a positive thing now coming from the Bund space. So we see more official institutions coming into the covered bonds market, which is a good thing. So the investors we lose to the corporate space, some of them, or some of the number comes back from the official institution. But all in all, I think the investor base has narrowed and is less diversified nowadays.
I think it's hard not to be positive about the landscape for covered bonds globally as an asset class in 2019. If you think about the conversations that we were all having in December, January, around how tricky things were going to be for the market, I think the fact there's generally been very little discussion about covered bonds as an asset class in 2019, and actually there's been much more focus around TLAC debt and the like within the bank financing space, is testament to the resilience of the covered bond market generally. I think one point which perhaps gives me even further hope is around, yes, there are the challenges of negative rates within the European market, but I think with the globalization of the covered bond product, the opportunity to sort of pivot into other markets remains there.
On the topic of ECB today, I guess, in relation to the state of the covered bond market, I think there is probably a lot more downside than upside priced in to the market. I think obviously it's going to be crucially important in terms of what happens to the outright market and the impact on swap spreads and asset swap valuations. But one thing that I don't think people are talking too much about is, obviously, if the ECB is planning to introduce a tiering concept to help support banks' NIM, one other aspect that they could introduce is, as part of the QE program, lots of market participants are talking about the number, but no one's really focusing too much on the actual scope and the substance of what a QE might look like. If they start introducing QE on bank senior debt, how is that going to impact?
That's likely.
I've heard people talking about it.
Not me.
Not you. No. It's in the less likely category, but I think it's something that we should be talking about.
Does the directive strike the right balance between being prescriptive and principles based?
Whenever I talk to investors about various topics in the sort of harmonization comes up, the moment you bring up the timeline, they switch off
Exactly.
on the other side of the table. You're not talking about something that is immediate, as Christina said, you're talking about something that is years down the line. It's not a driver for performance, for spreads. It incrementally improves their position, and it's good that in a low-yielding, low-spread product that you make things better from the get-go, so you need to spend less time on actually analyzing the underlying frameworks, because at the end of the day, if you don't get paid for the work you put in, you don't invest. So it's positive, but it's such a long timeline that most people just don't care.
This is taking incredibly long. I mean, this is just, and not just talking about the third-party recognition, just only talking about the directive itself, the time it took to get us where we are. And look, we are now no further than we were on the 17th of April. Nothing has happened. Maybe things have been translated. No one has started, I tell you, to work on the implementation, or if they have started, it's only last Monday.
I do agree it's a bit a pity that we've maybe lost a little bit of the momentum. I do think that some of the work has started, maybe not official meetings yet, but speaking from my own country, Spain, working groups, which were really dormant since the consultation paper 2015, have been reactivated. But in Spain, the transposition of the directive is going to require some further, quite larger changes.